Investing can be a daunting task, especially if you're new to it. But it doesn't have to be. In this video, we'll guide you through the basics of investing and help you get started on your journey towards financial freedom. Before we dive into the details, let's first understand why investing is important. Investing allows your money to grow over time thanks to the power of compounding. By investing your money wisely, you can earn a return on your investment, which can help you achieve your financial goals faster. Whether you're saving for retirement, a down payment on a house, or a child's education, investing can help you reach your financial goals. But keeping your money in a savings account or under your mattress won't help you achieve those goals. In fact, inflation can erode the value of your money over time. That's why investing in the stock market, bonds, or real estate can be a smart move. These investments have historically provided higher returns than savings accounts or CDS. But before you start investing, it's important to understand the basics. In the next segment, we'll cover the different types of investments and their risks and rewards. So, grab a pen and paper, and let's get started on your investing journey. There are many types of investments available, each with its own risks and rewards. Let's take a closer look at some of the most common types of investments. Stocks are one of the most popular types of investments. When you buy a stock, you're buying a small piece of ownership in a company. If the company does well, the value of your stock may increase, and you may earn a return on your investment. Bonds are another type of investment. When you buy a bond, you're essentially loaning money to a company or government. In return, you'll receive regular interest payments and the return of your principal when the bond matures. Real estate is another popular investment. You can invest in real estate by buying a rental property, investing in a real estate investment trust rate, or flipping houses. Mutual funds are another type of investment. When you invest in a mutual fund, you're pooling your money with other investors to buy a diversified portfolio of stocks, bonds, or other assets. Cryptocurrencies, such as Bitcoin and Ethereum, are a newer type of investment. These digital currencies are decentralized and operate independently of a central bank. Finally, gold and other precious metals are often considered a safe haven investment. These investments can provide a hedge against inflation and market volatility. Each type of investment has its own risks and rewards. It's important to do your research and understand the risks before investing your money. In the next segment, we'll cover some of the key factors to consider when choosing investments. When choosing investments, there are several factors to consider. Let's take a closer look at some of the key factors. The first factor to consider is your financial goals. What are you investing for? Are you saving for retirement, a down payment on a house, or a child's education? Your investment strategy should align with your financial goals. The second factor to consider is your risk tolerance. How much risk are you willing to take on? Investments with higher potential returns often come with higher risks. The third factor to consider is diversification. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce your overall risk. The fourth factor to consider is fees. Some investments, such as mutual funds and exchange-traded funds ETFs, charge fees for managing your money. It's important to understand these fees and how they can impact your returns. The fifth factor to consider is performance. While past performance is not a guarantee of future results, it's important to look at the historical performance of an investment before investing your money. The sixth and final factor to consider is taxes. Different types of investments are taxed differently. It's important to understand the tax implications of your investments and how they can impact your overall returns. By considering these factors, you can make informed decisions about your investments and create a portfolio that aligns with your financial goals and risk tolerance. In the next segment, we'll cover some of the common mistakes to avoid when investing. While investing can be a great way to grow your wealth, there are some common mistakes to avoid. Let's take a closer look at some of these mistakes. The first mistake to avoid is investing without a plan. It's important to have a clear investment plan that aligns with your financial goals and risk tolerance. The second mistake to avoid is reacting to short-term market fluctuations. The stock market can be volatile, and it's important to stay focused on your long-term investment strategy. The third mistake to avoid is investing in high-risk investments without understanding the risks. Investments with high potential returns often come with high risks. The fourth mistake to avoid is falling for investment scams. Always do your research and be wary of investments that promise high returns with little risk. The fifth mistake to avoid is investing before paying off high-interest debt. High-interest debt, such as credit card debt, can eat away at your investment returns. The sixth and final mistake to avoid is not saving enough for retirement. Investing can be a great way to grow your wealth, but it's important to also save for your future. By avoiding these common mistakes, you can make smart investment decisions and achieve your financial goals. In the final segment, we'll cover some tips for getting started with investing. Now that you understand the basics of investing and how to avoid common mistakes, let's cover some tips for getting started with investing. The first step is to create a budget. Before you start investing, it's important to have a clear understanding of your income and expenses. The second tip is to prioritize your financial goals. Determine how much you need to save for each goal, such as retirement or down payment on a house. The third tip is to start small. You don't need a lot of money to start investing. Consider investing in low-cost index funds or ETF to get started. The fourth tip is to seek professional advice. A financial advisor can help you create an investment plan that aligns with your financial goals and risk tolerance. Fifth tip is to focus on long-term investing. Don't get caught up in short-term market fluctuations. Instead, focus on building a diversified portfolio of investments that align with your financial goals. The sixth and final tip is to be patient. Investing takes time, and it's important to stay focused on your long-term goals. By following these tips, you can start your investing journey with confidence and achieve your financial goals. Remember, investing is a journey, not a destination. Stay focused, stay disciplined, and enjoy the ride. Good luck!